So the next session we have today is on insurability challenges. So how can Insurtech help address challenges presented by changing risk, and is set to explore the dynamic landscape of risk management in an era where traditional models are constantly being challenged by very new and evolving threats. I know it's an area that everybody is worried about. It's about an area that every company is starting to think very deeply about, around how you can kind of secure your company, secure your assets, and protect yourselves from kind of bad actors. And so this is something that I think there's going to be a bunch of very practical strategies that you're going to be able to take from this session and really start implementing them in your business today. And I'm very excited to introduce Karen. Karen is the co-founder and CEO of BCyber. She had 25 years in the financial services industry before she moved into SME cybersecurity. BCyber, the company she founded, works with financial services SMEs to protect and grow their businesses and very much demystify the technical challenges of them and help them kind of with their cybersecurity challenges. And Karen was recently named the 2023 inaugural Female Cyber Leader of the Year at the Cybersecurity Connect Awards in Canberra. Karen, over to you.
Okay, so can you hear me? No. Oh, you can hear me now. I'm from the country. You could have heard me without it anyway. All right, guys. So insurability challenges. So risk means different things to different people. And sometimes the hardest part is actually defining and understanding the risk that you're trying to mitigate. That's what Insurtech is all about. But the other thing that you need to remember, especially as an SME or a startup, is how are the investors going to view what you're getting up to, okay? Client is king or queen, okay? But so too are the investors. So one eye on the client, one eye on the investors. And I'm super excited to say today that our panel is going to cover all of it. So let's start with Ben from Descartes. Their mission is to provide financial protection for companies and governments when it comes to natural catastrophes and climate risk. But they take a non-traditional approach. So Ben, tell me about this parametric insurance, what it is and how it's different from general GI.
Yeah, so Descartes Underwriting is a specialist agency. We bring insurers and reinsurers on board our platform in order to support capacity relating to extreme weather and climate related perils. So in Australia, especially if you think about flood, cyclone, bushfires, drought, hail, we do them all. Effectively, we use the enabler parametric insurance product to enable us for our carriers to deploy capacity on these perils to address this uncertainty brought on by climate-induced uncertainty, weather volatility, modeling uncertainty, and a number of things. The whole thing with parametric insurance in this market, in the global market, is that it's not a new concept. I mean, I think there's a recent report by InsurtechLIVE London which puts the global parametric insurance market at maybe a few $1 billion right now, with the potential to grow with an extra zero behind that within the next 5 to 10 years. And it's more or less a means to an end, because effectively it provides a fairer allocation between the insurer and the clients on the ground, because the fact that you as the asset owner on the ground can take more control of the vulnerability mitigation, asset resilience, whereas the insurer takes care of the insuring the event in its rawest form. And then you have the onset benefits of having these predefined triggers in place as part of parametric insurances. So we paid out cyclone claims from the previous month within the space of working days, not month, not years. The cash goes straight into your bank account, or into the insured's bank account, for them to enable the bounce back, a quick cash recovery, and then they can basically decide what they want to do recovering from an event. So that enables a lot of, insurability challenges, as well as, claims frustration and contract frustration that's associated with traditional insurance models.
Okay, so from where I'm sitting, because I'm a very basic girl, what I understand that to be is you do the underwriting up front, you agree on triggers. Once the trigger event happens, you pay out the hard cold cash. Seems reasonable. So that's, to me, as a small business owner, if I'm stuck up in far north Queensland with a cyclone visiting me unwantedly, that's great. So it's very good that the client is winning, loving it. But what about your business? How do you manage your own business risk?
Yeah, so that's predominantly where the tech part comes in. So a lot of insurers and reinsurers in this global Nat Cat space have lost a lot of money, have lost their shirt and everything on it. So that's why everyone's all pulling out spectacularly. We slowly bring that capacity back in the market through basically sophisticated underwriting around historical atmospheric variables. It's all around looking at the physics of how and why these events happen. So for example, for our bushfire models, we have over 300 sort of atmospheric variables that you detect possible ignition points and the risk of a particular fire in the particular season within a particular region. And it gets very granular, but with so much sort of satellite technology available, radar technology available, and we use Internet of Things, IoT devices to be installed on sites as well. So with a blend of everything, you can enable a lot of these perils to be, I guess, priced up with a sustainable part of that sort of underwriting, pricing, and also the capacity sitting behind it as well.
Okay, so we've got clear underwriting of the perils. The client knows at the beginning of the game what they're going to get when disasters occur. So I think that's a huge win for everyone. But I know, speaking to a couple of the guys, over lunch, from a more personal point of view, I mean, I know Descartes had a really good Series B funding run in 2022. It was like really good. You really should Google this. How did you prepare for that? Because, a lot of people out there are looking to do a Series B funding, and they perhaps have never done one before.
Yeah, so it's quite a unique combination. So, so our founders are based in Paris, and they did the hard yards of having, I guess, a disciplined sort of look at the business model. And it's not about growth. It's a growth mindset, but with a very disciplined bottom line approach. So, because I mean, insurance can be a very much winner's curse, right? So everything comes back to, well, if you want top line, you just slap it on and hopefully it doesn't come back to you at the back. Whereas all these events are, you can quickly realize your losses immediately. So we tend not to do that. We tend to, I guess, pursue markets that are clearly overpriced or don't have a clear view of insurability and a lot of gaps in between, and that's where we would target them one by one until the market imbalance between buy and sell is more stabilized. Yeah, so we've got Series B now locked away. I guess the next stage for Descartes Underwriting is effectively scale up. So we're not burning any cash effectively. So maybe in a couple more years.
Oh, well, okay, you heard it here first. I get all commissions on the profits. Okay. All right. So we've just learned about how about looking, at sort of mainstream risk, slightly different ways, can lead to some really nice funding opportunities for you. But insurability is all about risk management. Okay, no gold stars for that statement. But supply chain risk, as we learned a little bit earlier, is in the news every day. It doesn't matter whether it's the basis of a cyber breach, which is obviously near and dear to my heart, or whether it's about a company who has an ESG breach caused by poor supply chain management. And that's where Kim and Fair Supply come into it, because they're looking at this type of breach, this type of risk in a non-traditional way. So how are you doing this with ESG and supply chain risk?
Yeah, so we like to think of every ESG risk as a supply chain risk. What we know about Scope 3 carbon emissions, modern slavery, biodiversity impact, is that often the biggest risk is hidden deep within a company's supply chain. And so without supply chain visibility, it's really hard to even identify the risk, let alone mitigate and address the risk. And so our technology maps global supply chains using a multi-regional input-output analysis as a basis, but has the ability to ingest companies' procurement data and investment data and then map the supply chain to tier 10. Once we've mapped the supply chain at an industry and country level, we're able to quantify ESG risk along each tier of the supply chain so that insurers and corporations and institutional investors can really target that supplier or company engagement where the real risk is to then go and address that.
Okay, so if I can be a bit controversial, why should I care?
I think you should care because you have to care now.
I'm being made to.
We've heard now, I mean, I started my career first as a commercial litigator, but then moved very quickly to the human rights space and actually worked for the largest anti-slavery organisation in the world. So have spent many of panels talking about, why everybody should care about ESG, but it's much simpler now. The regulatory requirements are mandatory globally. We're seeing new pieces of ESG legislation being introduced almost at a monthly basis, all which require visibility over your supply chain, at the very least to identify that risk, but in many circumstances, especially in the S of ESG, to undertake due diligence, not just on direct suppliers and people that you're contracting with, but with suppliers deep within the supply chain. We also, I guess the other reason, apart from regulatory compliance, stakeholder engagement, we're seeing a lot of this type of compliance actually be driven by institutional investors. So what we see is institutional investors and asset owners putting pressure on external fund managers putting pressure on portfolio companies, and then portfolio companies actually putting pressure on suppliers who may not be reporting entities but need to identify these risks as a license to do business with those reporting entities.
So you basically have to do it, okay? So it's in your best interest, both as a business person, but also for the greater
good of the people and the planet.
Absolutely. Now look, Fair Supply really at the heart of things is a data tech company. So what are you doing to ensure the sanctity and safety of all that data, so mitigating that particular risk?
Yeah, so because of our customers being so sophisticated, we were ISO 27001 certified in our very, very early days, which as a small business was quite, maybe a story for a TV episode in many years to come. But I think the amount of money and time and resources that we have invested into data security has really been at the forefront of everything we do, because we are plugging into customers' procurement and investment.
Yep, and I think that's a really great lesson for all of us. You need to build in that risk management right from the get-go. Don't leave it to the last piece of the puzzle.
And I think as a founder, it's really hard to navigate the tension, because you are often having to invest in risk mitigation that is sophisticated beyond your organisation's years, but not doing it could essentially, be a risk that you're not willing to take for the business.
Absolutely. Now, if we can learn a little bit from your experience as well, as we did with Ben, I know that you've had some funding experience with the Minderoo Foundation. I'm just wondering if you can share some of the key learnings from that for the audience.
Yeah, so Minderoo did our seed round and also participated in our Series A. As many of you know, as part of the Minderoo Foundation, Walk Free produces the global slavery Index, which is the most comprehensive modern slavery data in the world. And so Minderoo have been very incredible supporters of Fair Supply in the very early days, not just as investors, but as very real partners. In our Series A, Airtree led the round, and so I love working with both impact investors and also straight VCs, and actually learning a lot from very different investment theses, and I think having a contribution of both to the business has been very beneficial for Fair Supply.
Excellent. So I guess the learning there is find someone that truly believes in what you are doing and that you truly believe in what they're doing, and you can actually work together as a great team. So now we get to the pointy end of the puzzle. We're going to go into the investor lens. So Tenity is a global innovation ecosystem and early stage investor. Basically, we're at the show me the money stage. Okay? So when you're evaluating insurtechs, especially those on the cutting edge, okay, what are the key things you're looking at with that am I going to invest, am I not going to invest decision?
I think the first and foremost is the unique value proposition. We're in a day and age where we're talking about building sustainable businesses. So you can't shy away from building that unique value proposition, be it your clients could be the insurers, reinsurers, the brokers, agents, the policyholders themselves. You need to provide differentiated kind of value proposition for them. And this is where really the founders who have industry experiences actually shine, because they understand how the dynamics and the mechanisms of the industry actually works. And investors are at the mercy of these founders, knowing that and trusting them that they can actually navigate the ecosystems fairly. And then investors are there to support, but not to kind of direct you every turn of the way, because there will be a lot of turns that you need to navigate along the way. So that would be the first and foremost. I would say something unique about Insurtech is, compared to any other kind of sub-verticals within financial services, Insurtech is just as well regulated as any other sub-verticals. So I think it's very critical for you to find a way to work with existing partners. It could be reinsurers, insurers, agents, brokers, whoever it is, to actually navigate and create cooperative innovation in that manner, rather than trying to kind of take on the world and then try to fight the world, basically. Because I think we're at the point where the big traditional players are also innovating. We can't stay on the mentality that it's only the startups or the small players, the nimble players that are innovating. Yes, there are kind of legacy systems that we all want to kind of move away from, but then for some reason, there is a reason why people can't move away from it and are not tending to. So if you address them with an economic solution to move away from them, I think that would be the golden pot for addressing these concerns. Yeah.
Right, so when we're starting up, we're looking for what you're looking for. You're looking for someone who can actually enunciate or define key pain points and how they're going to address those key pain points. So what are some other common things that you see with the groups that you work with that have been successful with you?
I think talking about how in your interaction between startups and kind of corporate environment, I would say the two common best practices are good communication. And then second, it's about being patient. So about the communication element, you want to be speaking at the same level and at the same kind of perspective from the partner that you're trying to onboard as a client or even work with. So because they want to go into straight to the point, in the sense that does the person, the startup founder sitting across the table, do they understand the industry as well as you do? Or even better, right? So corporates and traditional players are not there to kind of teach you for a year or two educating you about the ecosystem, how the different dynamics work. So you need to be prepared and do your homework regarding, okay, am I really understanding the insurance industry well enough as the clients they do? So it's getting ready and being prepared to communicate on the same level and same bandwidth. And the second, I would say, is about being patient. So some very bullish founders, they're very eager to kind of get to the point and kind of really drive the project in the sense that they want it on their terms. But rarely it happens that way. And investors are there to kind of hold your hands along the way of frustration. But then I think it's about being patient and, more importantly, trying to really find a champion within that partnering company so that they actually become a voice for you rather than you trying to actually navigate the entire organization yourself. So you want this champion as informed as you are, as passionate you are about this project, so that they can go to their investment committee, they can go to their BUs, or even their IT teams. Look, we have this great solution. It can save us 30% on our bottom line. It's like you want this guy constantly knocking on the door because it might not be on the KPIs of the IT team to actually adopt the solution, right? So I think focusing on that champion and equipping that person as much as possible is quite important. Yeah.
Okay. All right, so not wanting to be too much of a negative Nancy, I have this theory, which you all have to now listen to. And I like to learn from the mistakes of others. I don't see the point in me falling into a bear trap when someone else has already done it and been hurt. So I'd rather let someone do it and then I just watch and learn. So based on that, what are some common deal killers? You know, when you're almost at the end and then something happens and you go, yeah, that's never going to happen.
I mean, usually the deal killers usually happen in the very beginning. So I think some of the red flags that I see are the teams that are trying to reinvent the wheel. So I know we're at the very exciting stages of new technologies popping up, but I think as finite beings we don't need to reinvent the wheel. I think we've seen cases where some technologies actually are providing innovation and disruption into the traditional fields, but then you're going to be challenged a lot throughout the days. And for investors, we like businesses that have least amount of obstacles along the way. So yes, we love disruption, but then let's make calculated kind of fights along the way. So I think reinventing the wheel is one. The second, I would say, is, as I mentioned before, we're no longer in the economy where we can fundraise for the sake of scaling. So I think it's very important for you to actually build a strong foundation for the business in the sense that you have a sustainable business model. While you might not be profitable right now, you have a pathway to that, and the levers that you can actually tweak along the way giving you more economy of scale to getting there. So yeah, I think investors acknowledge now also that, yeah, we might be pumping in billions of dollars, but then when the product hits the public markets, it's not going to be valued like that. So yeah, I would say those two.
Okay. And for the Insurtechs in the room who are starting to think about fundraising and they've never done it before in their life, and they're just sitting there going, I know I've got to do it, I just don't know where to start. What would you suggest?
I would have 3 suggestions. Start close. So everyone has different sets of proprietary network. So it could come from your family backgrounds, your friend network, or even previous experience, colleagues or bosses that you have, or even clients that you've met along the way. I would ask you to start close in terms of if you can find initial kind of angel investors who also believe in this idea and can guide you and provide advisory. I think that's a great way. I would say second, if you're then going into product market fit, there are resources like Tenity, for instance, early stage investors through more program and structured environments where you can actually address those kind of product market fit questions, and they can actually open you up to more of the structured network, such as mentors or advisors. And also their grants. These are basically, you have to work for the money, but you don't have, there's no equity stake that you need to pay out. So I would tap into those because I would say those are free money. So tap into those. There's so much resources out there right now. I'm sure Insurtech Australia is doing a great job kind of connecting you to those resources. And government agencies, of course. I think we've heard about that. I would say then third, what was it? Sorry.
It's a good one.
Yeah, I think third and foremost, I think this goes back to my first point, which is building business. I think we should never lose sight of the fact that we're building a sustainable business rather than fundraising for the sake of fundraising, right? So you should actually just raise the amount of capital you might need for the next 2 years, right? You shouldn't be looking at, okay, I'm eyeing for NASDAQ IPO, and then I'm going to need, I don't know, $2 billion in funding to support that. I mean, there are plenty of companies that actually raise more than that, right? Especially in Southeast Asia. Yeah, I would be mindful of kind of reflect on what your true goal is, which is building a sustainable business. So I would suggest, first and foremost, is make sure all these investments and investors are aligned towards building that, rather than trying to sell you off to the next secondaries market. Yeah.
Okay. And my cheeky question for the day. So if anyone here wanted to have a chat to you later, that would be okay?
Yes.
Okay, there you go.
I've
made the instruction, like the introduction to say, Karen said I had to, and you're all good.
Yes, she will be taking a cut from it.
That's right, of course. Fully disclosed.
But we're actively looking for early stage financial services startups across the region and also Europe as well. I look after the origination and execution of Asia Pacific ones. So the stage that we're looking at is usually around 1 year of operation and incorporation. Anything that has to do financial services, fintechs, insurtechs, regtechs, or even other verticals. I know agricultural tech is a really strong point in Australia, but as long as they have kind of very good, good ties to financial services. So,
cool.
Yeah. Speak,
lovely,
please.
Thank you. So you've got lots of handy hints. Are there any questions? Because we've got a few minutes that you can actually ask questions for. Any questions? I feel like
I've got a roving mic.
Oh, a roving mic. Oh, God, we've gone high tech.
Anyone who's got one? Come on, hands up.
No one ever likes to ask these questions, do they? I'll ask a question. Alrighty, so with all the recent weather events in far north Queensland then, how did you and your team deliver on the promise of immediate payout, basically?
Yeah, so like I mentioned before, the whole thing behind the concept of parametric insurance is all pre-agreed, so everything is determined from the beginning, including the how and when the claim payment is made. So we contractually would do it within 30 working days, but the recent events proved that, yeah, fine. I mean, it went as per advertised. We had some big ones up in Asia last year from the 2 or 3 subsequent typhoons in the region, and yeah, like 6-figure, 7-figure dollar sum straight in the bank account within, I don't know, 10, 15 working days. Clients are usually pretty happy after that. I think we had one that came back and upsized.
Okay.
So they've decided to reinvest some of that back, which is always a good tell sign that insurance is per advertised. It's working as per usual. So yeah, I mean the whole market is expected to grow, so we do need these a good brand and image out there for insurance in general, and these things are supposed to work as usual. The fun North Queensland events are, they're just, I guess, tip of the iceberg, because, I mean, with rising sea temperatures and the various likes, there's a high evaporation rate, I guess, in the air, and that causes higher moisture content, as well as elevated frequency of storms and rainfall and cyclones and whatnot. So, yeah, there's a whole
thing.
There's a whole behind it.
So just building on that, Kim, how would you suggest that the small and medium insurtechs build in the ESG risk management piece into their business from the get-go rather than at the end?
Yeah, I like to describe the ESG landscape now like health and safety perhaps 10 to 15 years ago. ESG will become BAU. Funds are needing to report to their investors. Companies will need to be reporting to their customers that they're trying to attract. And I think if you set strong foundations in terms of how you report on ESG holistically and don't silo it within your organization, you will set yourself up for success because you can build and go deeper on those foundations. But if you are looking at ESG issues in a silo, there will come a point in time very quickly where you're going to need to be measuring how they intersect with one another. So the best advice I can give is you should be doing it now, and you should be doing it in a way where you're laying foundations for the intersection of ESG issues, because having organisational silos for the E, the S and the G will actually not be sustainable for the business as the ESG market changes so rapidly.
Well, look, if there are no questions, please join me in thanking our fabulous panel. We've covered so much, so thank you so much, guys. I really appreciate it.